Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business and see if they're cooking the books or just cooking up something good. Today, Molina Healthcare is dropping some news, and let's just say it involves more borrowing and less paying back for now. Before we dive in, if you love getting the real scoop from these filings, make sure you are subscribed, and if you want to chat about this and other corporate secrets, join our Discord community. It is linked right down in the description. So Molina Healthcare, a big player in healthcare services, has just announced they're planning to offer a whopping $750 million in senior notes that will be due in 2031. This isn't just any offer though, it is a private offering, meaning it is not for everyone, but specifically for what they call qualified institutional buyers and certain non-US persons. The main reason for this big borrow, they want to use the money to pay back some of their existing loans, specifically what they call delayed draw term loans, under their current credit facility. It sounds like they're swapping out one big debt for another, but with a twist. Not only are they looking to raise all this new cash through the notes, but they also plan to ditch their old credit setup and bring in a brand new revolving credit facility. Now, revolving credit facilities are basically like a credit card for companies. You can borrow money, pay it back, and borrow it again. They expect this new facility to have terms pretty similar to the old one, but with some tweaks that are supposed to be even better for them, especially with how certain rules or covenants are set up. It's interesting because they currently have zero borrowed on their existing credit line and plenty of their own cash. So this new facility, which will also be undrawn at first, is really for future flexibility, like paying for day-to-day operations, buying other companies or funding big projects. They've actually already got commitments for the full amount they want for this new credit line, and they aim to have it all sorted out around the same time they finish this note offering. However, and this is a big however, there is no guarantee that this whole plan will actually happen. Deals like this can fall apart. Now, let's talk about how Molina Healthcare is presenting itself to potential investors. They're putting a lot of emphasis on two financial measures, EBITDA and adjusted EBITDA. If you are not familiar, EBITDA basically means earnings before interest, taxes, depreciation, and amortization. Think of it as a way to see the company's operating profit without some of the accounting and financing costs. Adjusted EBITDA takes it a step further, stripping out other things like stock-based payments, costs related to buying other companies such as acquisition, related expenses, and any one-time or non-cash charges. They believe these measures are useful for investors to compare them against other companies in the healthcare world. However, and this is a crucial point, EBITDA and adjusted EBITDA have some pretty significant limitations. They don't show how much cash the company actually has left after paying for taxes, or how much money they need for big projects like buying new equipment or buildings. They also don't account for changes in their day-to-day cash needs or the big interest payments they might have on their debt. And while depreciation and amortization aren't cash expenses right now, the assets being depreciated will eventually need to be replaced, and these measures don't factor that in. Basically, they're trying to paint a picture of their ongoing business performance, but it is not the full cash picture. Let's look at some of the numbers they provided for the 9 months that ended the 30th of September 2025. Molina Healthcare reported a net income of $632 million. Now, when we look at their EBITDA for that same period, it jumps up to $1,094 million. And then the adjusted EBITDA, which adds back things like stock, based compensation and acquisition costs, goes even higher to $168 million. It is a pretty common practice for companies to highlight these adjusted numbers to make their performance look stronger, but it's important to remember they are not GAAP measures, which are generally accepted accounting principles. Looking at the yearly figures, we see fluctuations. For the full year 2022, net income was $792 million, with EBITDA at $1,349 million, and adjusted EBITDA at $1,709 million. Then in 2023, net income jumped to $1,091 million, with EBITDA climbing to $1,744 million and adjusted EBITDA to $1,934 million. However, for the full year 2024, the net income was $1,179 million, a bit higher than 2023, but the EBITDA actually decreased to $1,893 million and adjusted EBITDA to $2,091 million. This shows that while net income looks good, the underlying operating performance as measured by EBITDA has dipped, and the adjustments made to get to adjusted EBITDA have also increased. One figure that stands out is the impairment charges of $208 million in 2022, which the company notes was due to their plan to reduce their leased real estate footprint. This suggests they might be shedding office space to cut costs or adapt to a changing work environment. Digging into the footnotes for 2023, we see some non-recurring charges impacting their numbers, like a credit loss on receivables related to an issuer's insolvency in Texas, legal costs, and one-time termination benefits. These are the kinds of expenses that can skew short term results and are why looking at trends rather than single periods is so important. Now, a quick word from Molina Healthcare itself. They've included what is called a safe harbor statement. This is a standard legal disclaimer in many company reports. Essentially, they are saying that when they talk about the future, like their plans for these new notes or credit facilities, these are just their current expectations. These expectations are based on certain assumptions. And there are a lot of risks out there that could stop these plans from happening or make the actual results very different from what they're expecting. They're telling investors not to put all their trust in these forward-looking statements because things can and do change. They're also making it clear that they don't have any obligation to update these statements if things change, unless the law requires them to. The core of this filing is really the press release about the senior notes and the new credit facility. It is their way of sharing this important financial maneuver with the public. They're not trying to sell the notes directly through this report, but rather informing everyone about their intentions. The notes themselves haven't been registered under the Securities Act, which means they can only be sold under specific exemptions. This is all pretty standard as they arrange new debt financing. So, what's the big picture here? Molina Healthcare is essentially refinancing its debt. They're issuing new, longer term debt to pay off existing loans and setting up a new credit line for future needs. This is a common strategy for companies looking to manage their debt, potentially lower their interest costs, or simply ensure they have access to funds for growth. The numbers show a company that generates significant earnings, especially when you look at their adjusted EBITDA figures, but it also highlights the difference between those earnings and the cash the company actually has. The impairments and the various recurring charges mentioned in the footnotes suggest that there are always one-off events that can affect profitability, and investors need to be aware of these. Looking at Molina Healthcare's direction, they seem to be strategically managing their capital structure. The move to a new credit facility with potentially more favorable covenants, alongside issuing new debt, suggests a focus on optimizing their financial flexibility and possibly reducing their cost of borrowing over the long term. A key opportunity for them will be how effectively they can deploy that new credit line for strategic acquisitions or capital expenditures that drive future growth. On the risk side, the market conditions for issuing these notes are always a factor, and as they themselves state, there is no guarantee they'll get the deal done on their terms or at all. Also, the healthcare industry itself is constantly evolving with regulatory changes and competitive pressures, which can impact a company's financial health regardless of its debt structure. In conclusion, Molina Healthcare is making a significant financial move to restructure its debt and secure future borrowing capacity. While the adjusted EBITDA figures look robust, it is critical to look beyond those headline numbers and understand the underlying cash flows and the various adjustments being made. They're navigating the complexities of corporate finance, aiming for a stronger financial footing. Alright, that is our breakdown of Molina Healthcare's latest announcement. What is your take on these financial moves and what they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into the corporate world. And don't forget to check out the Discord in the description to chat with us and other viewers. Thanks for watching. See you next time.